Welcome to the Justice Eben Show, sponsored by Palmetto Privacy. Palmetto Privacy is a Greenville-based technology startup developing products to keep the internet safe and free for all. Go check them out today at palmettoprivacy.com. Today, I'm joined by Nate Dean, the co-founder of Unlimited Life Concepts. Thanks for coming on the show. We're really glad that you can make it. I'm really excited to kind of just do like the as deep as you're comfortable getting into kind of like the technicals and specifics of infinite banking. It's something that we talked about a little bit last year, but like I'm fascinated by infinite banking since I was like 17 and I read R. Nelson Nash's book. And I just want to spread the gospel of infinite banking because it's so cool. You are an expert in something called infinite banking. And what you do over at Unlimited Life Concepts revolves around this concept of infinite banking. The way that I have put this when I'm explaining it to people is that it's the answer to the question, if I'm an average person making kind of average money and expecting to have like an average career, how can I still guarantee that I become a millionaire kind of before retirement age? Is that a fair way of like, is infinite banking kind of the answer to that question?
I think so, because most working class, they have zero confidence in when they're going to retire and how much they're going to retire with one day. Mm-hmm. A lot of people are just crossing their fingers, just hoping that it's going to be enough, hoping that it works out. And the reason I say that is because I used to be one of those people. I used to be in a situation where, I was working, I was providing for my family, but, the thought about retirement in the future, like, I didn't know what that was going to look like. I had zero confidence in that. So yeah, infinite banking really gives people a peace and a hope in their finances that they've never had before. And I've said this before. I made the comment one time that infinite banking tells the future, and obviously there are no guarantees in life. So don't misunderstand me when I say that. But we are dependent on a 100+ year track record of the life insurance industry and the life insurance companies that we do business with. So we can look at over the last 115 years as an example and see where a life insurance company has posted a profit and paid a dividend to their customers, even through depressions, recessions, you name it. So we can look and at the foundation, the financial foundation of the life insurance company and say with relative certainty, hey, at a minimum, this is what you can expect in the future.
Okay. And just since now we're already getting into the life insurance part of it, can you define infinite banking in the TLDR sort of sense?
Yeah. So this guy named Nelson Nash years ago figured out a way that there was, that you could properly structure a dividend-paying whole life insurance policy to create your own private banking system. And to break it down in even simpler terms, imagine having a line of credit at the bank. Well, in that equation, the bank owns the line of credit, and the bank controls the terms of when that line of credit has to be paid. And sometimes they can even cancel your line of credit. So with infinite banking, what you are basically doing is establishing an ever-growing line of credit that you own and control, where the bank's not earning interest off of it, but in effect, you're earning interest off your own line of credit. So it gives you the ability to leverage cash in a really safe environment that you have control of, which becomes really, really powerful over time.
Okay. I think, first of all, I think that maybe a definition of like banking or fractional, because I hope everyone knows how banks work, but I don't think that's necessarily the case. So, just quickly, like, how does a bank make money? Because that's going to illustrate what it means to have a private banking system.
Yeah. So banks only make money off of your money. So a bank takes in a deposit, and then they find other people to loan that money out to. Now, they don't just take your money and go loan it to someone else. There's this thing called fractional reserve banking, as you just touched on, that gives the bank the ability to create money out of thin air. And so the reason that fractional reserve banking came into the picture is,
Mm-hmm.
or the reason why it's even a practice that has been done for as long as it has, is the banks are crossing their fingers and hoping and calculating that not everybody's going to show up on the same day to get their money out of the bank. So
Okay.
by taking these deposits and breaking them up into fractions and loaning them out to other people, they are just banking on the fact that they're going to have money at all times to support anybody who needs to come get their money out of the bank. Now, there's an old
Right.
term called a run on the bank that we don't hear about as often anymore, but a run on the bank meant that too many people showed up on the same day to get their money and the bank didn't have it to give.
Right. This is what happens in It's a Wonderful Life.
Yeah, exactly.
Okay. Okay. So the bank is taking in deposits. They are then loaning out the money that is deposited at a higher interest rate, paying you an interest rate on your deposits and pocketing the difference. But they also have this ability to kind of make money out of thin air, like by means of taking out loans from the Federal Reserve at super low interest rates, right?
Right,
So
right.
it's like for every dollar you deposit, they are able to take like $10 out of the Federal Reserve and re-loan that money out at a higher interest rate. So it's kind of a racket. I mean, it feels like a racket when you put it in like very plain terms, which means it probably is a racket.
It feels
What
like a
you're
house of
doing with,
cards.
yeah, it definitely feels like how, when you understand like just in very simple terms what's happening, it sounds incredibly unstable, unreliable. Like it just sounds like a racket. Um, and what you're doing with infinite banking is you're using whole life insurance in order to create a private bank for like a person. Is that one way of looking at it?
Yeah, so you're always going to need a medium of exchange. So I still have a traditional
Mm-hmm.
bank account. I just don't leave all my
Yeah.
money in the bank the way I used to. So
Yeah.
now I have my policies through the life insurance company. I have my policies that I can fund and feed, and also for expenses that I have in my life, or even assets I want to invest in. I'm building up a bigger pool of money that I have access to, that I control, that I can
Mm-hmm.
leverage, and the ability to leverage that cash is really important because that means that I'm taking a loan against that pool of money that I've built up inside the life insurance company, and the life insurance company keeps growing that money for me.
Mm-hmm. Mm-hmm. Okay, so let's kind of dive into some of the specifics here. I'm interested in doing infinite banking. I'm just getting started. I don't have a whole life insurance policy. I don't have like a retirement plan. Nothing. All I've got is like $10,000 in a savings account, and I know I'm going to be making $40,000, $50,000 a year for the rest of my life. I'm never really going to make like maybe I'll make six figures one day, but I'll never make like lots and lots of money. I'll always be kind of working for someone else and making a reason like a small a regular amount of money. And now I want to guarantee that when I'm like 55 or getting ready to retire, I'm going to have $1 million in capital to access. What's like the first step? What do I do when I come to you, Nate?
Well, the first thing that we're going to do is we're going to go through the educational process and making
Yeah.
sure that you fully understand what infinite banking is, because we're never going to move anybody over to implementing a strategy that they don't understand. So once we've gone through that educational process and you understand what infinite banking is, what it's not, then we move on to the discovery process, where we look at your cash flow and your resources, and also your assets, your liabilities, all that stuff. And we're going to design a custom strategy that's going to be built around all of those things. Because if you need X number of dollars at some point in your life, well, if your resources and cash flow don't support that early on, we can only work with what you have to work with. So we're going to design that strategy around what we know now, not what we hope for the future, but what we know now. And if you have debts, we're going to show you how to leverage your policy to what we call shift the wind current on those debts. So one of the first, as an example, one of the first things that I did when I got started with infinite banking was I had $4,000 on a credit card that I was paying 20% interest on. So when
Yeah.
I started my policy, the first thing I did was I took a loan against that cash value and I paid off that credit card. Well,
Okay.
the payments that were going out the door to the credit card company, now I just started feeding my own system with those dollars. So I shifted the wind current on that debt where I turned it, what was guaranteed costs going out the door every month, I turned it into guaranteed cash flow coming back to myself.
Let's go back to the educational component, because I think that
Yeah.
people are probably at this point, they're starting to grasp. Okay, so I'm creating a private banking system, right? Which means that I will have some kind of pool of money that I will be able to take out loans against, and that the interest, rather than paying it to a bank, I'll be paying it to myself. So I think that people probably understand that concept, but the question is, okay, well, what is the pool of money? What is like the mechanism for establishing this pool of money? Can you, I mean, just talk about the relationship between whole life insurance and private banking.
Okay, so whole life insurance, the characteristics of a whole life insurance policy that's structured properly for infinite banking is there is a
Mhm.
portion of that money in the first year that goes straight to the death benefit portion of the policy. There's another
Mhm.
portion of that money that goes straight to what we call paid up additions. It's a rider that is added to the policy, but what it does is it creates an opportunity for us to grab cash and create cash value right out of the gate. So we have the
Mhm.
ability to start leveraging that cash much quicker than in a traditional whole life policy. It took, you know, 20, 25 years sometimes for you to see the full value of what you had put into a policy. And
Mhm.
so in just traditional whole life, Dave Ramsey says whole life insurance is the worst place to put your money. Well, a traditional whole life policy is not the greatest place to put your money. But I will say this, I've worked with a lot of successful people over the years since we started our business, and almost every one of them already had a whole life policy in place. They were just
Yeah.
never taught how to be their own banker with it. So if whole life
Mhm.
insurance, if just forget infinite banking for a second, if whole life insurance really was the worst place in the world to put your money, why would successful people still see value in that? It's
Well,
because,
let's talk about that. What
yeah,
I mean, 'cause you're saying whole life insurance. I feel like people hear whole life insurance and they understand what they understand life insurance.
yeah,
Every month I pay a premium, and then when I die, I get a payout. And then they might understand there's term life insurance and whole life insurance, and then they might understand there's like universal, indexed, all these different types of life insurance. Can you kind of make the distinction between whole life insurance and term, and like universal? I think is one of the other
yeah.
ones.
So a term life insurance is pretty straightforward. You pay for a specific term, whether it be a 10-year, 15-year, 20-year, 30-year, and the insurance
Right.
company looks statistically at your age and says, what are the chances that this person is going to die? That's really what it boils
Mhm.
down to. And their
Right.
premium is based off of your age and other health factors and everything like that. What's important to understand with term life insurance is it's the number one profit center for any life insurance company because I think only like 2% of those policies ever pay out. So it's a
Mhm.
very, very small percentage. So the odds are always in favor of the life insurance company. So
Right.
you buy that term policy for X amount of years, however many years you determine you need it. And once you have paid, if you haven't died, then that policy has to be renewed or canceled, one or the other. When you
Right.
renew it, they're going to renew at your new current age, which means the policy is going to be a lot more than it was prior for that
Right.
term that you had locked in.
And you have nothing to show for it.
Nothing at all.
Okay.
Yeah, you basically just funded the coffers of the life insurance company for that amount of time. So with whole life insurance, as long as you are paying the premiums on your policy, then they guarantee to
Mhm.
cover you once that policy goes active. So,
Mhm.
and with a term insurance policy, once you understand this, term insurance, your cost of insurance keeps going up as you get older. As time goes on, your cost of insurance starts going up. With whole
Right.
life insurance, especially with an infinite banking plan, your cost of insurance starts diminishing from day one, and it gets less and less as time goes on. So,
Can you explain that? Because your premium doesn't change.
yeah, your premium doesn't change, but in your early capitalization years of a whole life policy, that's where the biggest expense for the insurance portion of the policy comes from. But as
Okay.
the growth of the policy continues, as the dividends get better, as the cash value grows, everything like that, your
Yeah.
cost of insurance just gets to a point where it's nothing at all. The policy's paid up, which means everything
Yeah.
going forward is going to be tax-free growth, that you're not going to have to worry about any additional costs that you're going to incur.
Got it. So okay. So you said the magic word, cash value, and this is where I think people just are not gonna know about this, right? So you
Yeah.
got a whole life insurance policy. It's almost like putting money in a savings account, but not like when you put $250 in premium into a whole life insurance policy, it doesn't mean you have $250 in cash value, at least at first, right? It's like,
Yeah, not at first.
right, because it's actually it's a little bit less than that. But as that cash value builds, which is, I mean, basically it's sort of like putting money in an account, and they are investing the dollars to create a return, and then paying you dividends. But you're building up cash value. Your premiums are building up cash value, and that cash value is essentially the value of the policy, right? And then at some point, you kind of cross a threshold where you're actually like every $250 you put in is actually worth more than the $250 you put into it because of the returns. Can you kind of just talk like what is happening there? Like what are the constituent parts of a whole life insurance policy?
Let's think about the policy as a whole as an asset. Now, we're not taught that whole life insurance is an asset, but let's think about this for a second. Your death benefit, just like everything else in our lives that we're building right now for ourselves, one day has to be passed on to someone else. So if you build up a real estate portfolio, you can't take it with you. You know, it's got to go to somebody else. So whole life insurance is an asset. Your death benefit on your policy is part of your asset column. That's part of your future net worth. It's not for us, it's for the next generation. It's for, whoever we're wanting to leave a legacy for.
The death benefit is when you die, the money that gets paid out to your son, your next of kin.
Right.
Okay. Your beneficiary, right?
So the cash value that you're building inside the policy that you have access to is the equity that you control. That's the simplest way to understand what cash value is. It's the equity that you're building inside that asset. Now, it's an ever-growing asset because the death benefit actually continues to go up higher and higher every year. So it's not fixed. It's something that continues to grow more and more as time goes on. So not only are you building a really cool system for yourself that you control, that you can do a lot of cool stuff with while you're here on Earth, but you're also building something bigger and bigger for the future.
Yeah. So I think that the threshold where your cash value becomes more than the premium you paid into it typically happens around like 7 to 10 years into the policy, right? Like this is not a get rich quick scheme.
No, it's not. It's not.
Okay.
You might call it get rich slow.
Yeah.
So your threshold,
but get rich slow with almost no risk. Like the difference between this and investing in the stock market or something, which is also a get rich slow scheme, unless you're really, really talented. The difference is that you're not looking to get rich in 5 years. You're looking to get rich in like 30 or 40 years, kind of. That's sort of the timeline. Before it's like, oh wow, I've got like $1 million in cash value. I can just take out a loan against it. Is that right?
Well, I mean, it's not an accumulation strategy the way we traditionally think about like 401ks and everything like that. Because when you're accumulating for a 401k, you have zero value that is created in your life because of a 401k in the immediate. And 401k, there's nothing in the 401k that's guaranteed. So there's no way of us knowing really what's going to be there when we need it the most. So what we're doing with infinite banking is we're removing a lot of uncertainty about the future. And we're also taking the things that we know right now that could be a problem in the future, and we're kind of knocking those out as well. Because any sort of growth that we have in our policy is tax-free growth. We're not going to have to worry about the taxes in the future. And
Right.
with a tax-deferred plan like a 401k, we don't know what the tax rate is going to be in the future. But if
Hmm.
you ask 100 people, 99 of them probably are going to say taxes are going to be higher in the future. If you look
Right.
historically, we're actually in a low tax environment right now in the grand
Yeah.
scheme of things since the
Yeah.
Federal Reserve and the IRS were first brought into the picture. So we do believe taxes are going to be higher in the future. So if we're looking at a pre-tax plan versus a post-tax plan, the way we think about it, the way we like to envision it is, if we were standing in a field full of wheat and I had a single seed in my hand and I said, would you rather pay taxes on this seed right here or this entire field? Well, obviously
Hmm.
we want to pay taxes on the seed, not on the harvest, because the harvest is much
Right.
bigger. So
Right.
we get those uncertainties out of the way now, and then we just don't have to worry about that in the future. Because
Right.
tax deferred plans, when you think about it, you're creating an unknown debt to the government to be determined by them at a later date.
Right. Right. Okay. So you've now touched on the tax benefits a little bit, and I think we'll return to them. But I want to just kind of stick with this example because I really want to sort of illustrate what's happening here, which is like, okay, let's say I'm 20. This is actually basically my situation. When I was in my early 20s, I bought my first whole life insurance policy. The premium was $250 a month. Is $250 a month still? And the death benefit I think is like $300,000 or something like that, right?
Yeah.
So a couple things happened, right? I sign up for this whole life insurance policy with a mutual life insurance company. And we'll talk about what that means. Immediately, I've got this death benefit of 300 some $1,000. So if I die, my mom gets paid out basically everything that she's invested into me over the course of my life. Right. From day one,
Right.
this is like immediate sort of peace of mind that I'm not just like, if I for some reason get hit by a bus or something, I haven't just been a complete, like waste of money for my parents. Right. So that's benefit number one, just right off the bat.
Well, can
But
I
then
just
also,
say
go ahead.
that brought up something that I thought about. You're basically buying insurance on your capital. That's another way to look at this.
Okay. Explain that a little bit.
Well, I mean, so think about an IRA as an example. Like if I put 20 grand
Yeah.
into an IRA and something happens to me, my wife gets 20 grand. If I put 20 grand into a policy, my wife gets several $100,000 if something happens to me.
So this is like one of the immediate benefits, and it's the one that was the most surprising to me because I really didn't expect there to be any immediate benefits, but there really was. Like in my early 20s, I was a degenerate, partying all the time, participating in extremely risky behaviors, right? And there was this sort of peace of mind that was like, well, like I'm completely sauced out of my mind. I'm having a hard time breathing. I know tomorrow's going to be a bad day if I wake up. But if I don't wake up, my parents are getting paid out hundreds of thousands of dollars, and I was not a complete waste of their lives. So that was an immediate benefit that I don't think that I expected. But then what you see start happening is, for like, I think at first when I would put like a month's premium in, it would be worth like 2/3 of the premium. So like $250 in, $160 in cash value, right? Something like that. And then you just start seeing it grow and you kind of ignore it. And a few years later, I'm like, okay, I'm ready to pay off my student loans. And so I take out like 10K and with there's no interest from the life insurance company, or if it is, it's really minor. Um, and I pay off my student loans, which have got like 8% interest, right? So I just save the 8%. But what the infinite banking part comes in where you're saying, well, no, you still want to pay that interest, right? Can you talk about like that, like example?
Okay, so this is something that people misunderstand sometimes. I had a conversation with a buddy of mine who's one of our clients just yesterday about this. People misunderstand the interest portion of the policy and how that works. Some people believe that when you pay interest on your loans, you're paying that interest straight back to yourself. And it really depends on how you think about it. So this example that I use, let's say you had $10,000 saved up in your cash value in your policy. and you needed a loan for the full 10,000. So
Yep.
you request the loan from the insurance company. The interest that they charge, because there's still a cost to capital, because remember, you're borrowing their money, not your money. So there's a cost to capital. Let's round it up and say it's 5%. It's actually less than that, but let's say it's 5%. Now it's a simple interest loan. So what they're going to do is they're going to subtract 500 and they're going to send you the difference. So they're going to take out 500. They're going to send you 9,500. Now that simple interest is set up for the 12 months. The life of that loan is a 12-month loan. If you pay the loan off in 6 months, they're going to credit half of that interest back to you. They're going to credit it back to you. Now, so if I paid it off in 6 months, 250 would go back to my account. The other 250 goes to the insurance company. But the reason that doesn't matter is because as a customer of the company, we get to participate in the profitability through dividends. So
because it's a mutual life insurance company.
Exactly. So long term, any amount of interest that I'm going to pay to the insurance company, I'm not worried about that at all, because I know that it's either coming back to me or it's coming back to my family one day.
Can you talk about what it means because this is a critical part of the strategy, which is that there are mutual life insurance companies and then there are non-mutual life insurance companies.
Yeah. So you have
what is the difference in?
Yeah. So you have a stock company, which means that the stockholders of that company are the ones that participate in the profitability of that company through dividends. With a mutual company, the mutual company is set up in a way where the customers actually, in a sense, become the shareholders. So the profitability gets returned back to the shareholders.
One question would be like, why would you ever do it any other way? Because that seems like a situation where all the incentives are aligned, right? Where you have policyholders encouraged to be responsible because they own the company, and you get the company encouraged to be responsible because they have to provide dividends to their policyholders. The simple answer is, well, profit, right? Like people want to own life insurance companies that they don't actually use. Okay. So a mutual life insurance company, as a policyholder, you are participating in the profit of the life insurance company's investments. I pay in premiums. The life insurance company loans those premiums out or makes investments and then pays you back in return with dividends that go directly into the cash value of your policy.
Right. Yeah. Dividends are reinvested back into the cash value.
Okay. So the mutual insurance company is one of the stipulations. The other stipulation is something called, and this is something that I've never really fully understood, which is this direct recognition concept. Can you explain what it means for a mutual life insurance company to be a direct recognition insurance company? Okay.
That means that the insurance company directly recognizes when somebody is taking loans out of their policy. So what happens is the dividend scale that they would use for someone who has all of their cash value sitting in their policy versus someone who's actually utilizing their cash value is going to be different. So when the insurance company goes to pay out the dividend, they're going to look at each customer and see what percentage of their policy are they actually utilizing, which in the grand scheme of things really makes things a lot more fair in our mind, because in a non-direct recognition company, that means everybody is getting the same amount, no matter what, whether you're using your policy or not. Everybody's getting the same amount. Personally, I feel like direct recognition has a greater chance of sustaining profitability. I could be wrong with that, but that's the way I feel, because they're guaranteeing a return on their capital no matter what. Now, the reason that I don't mind taking less of a dividend, because I have direct recognition company that I have policies with, is because the minuscule amount that it's affecting my dividend doesn't even compare to the value that those dollars are creating for me right now in my life somewhere. So, like as an example, like if I take out $10,000 out of my policy, and when the policy renews, the insurance company looks at that and says, well, he's got an outstanding loan for $10,000. I'm estimating here, but that's probably going to be around $65 or so that I'm going to miss out on dividends. But if I've got that
Right.
$10,000 working for me in a cash flow producing asset, I don't care if I'm missing out on $65 in dividends.
Right. So the direct recognition is basically they tie the amount that you use the cash value to your dividend payout.
Right.
Um, I'm following this, and this kind of creates a sort of efficiency, I guess, in the company where, like, by doing that, they're able to, I guess, pay out dividends sort of more fairly among the policyholders. Okay. And this is a concern that only exists in mutual life insurance companies, right?
Right. Right.
Okay. So what we're trying to figure out here is, like, what are the life insurance companies that can provide the policy that will allow me to build an infinite banking system? Okay. I want to get a little bit more complicated now. So we've explained what I'm doing here is I'm buying a life insurance policy. I'm paying in premiums. The premiums grow cash value in the policy, which is sort of like the equity or the like the value of the asset. You're then able to take out loans from your own insurance company against that cash value. They give you extremely favorable terms on that loan. I've never heard of one of these loans being denied. Have you ever heard of a loan application being denied?
They
I
don't
don't
even
think it's
ask.
ever. I don't think.
They don't ask you what the money's for. When you take out loans, they don't even ask you what it's for. They just process
Yeah.
them.
Yeah, and they don't do any credit checks or anything like
No.
that. It's just like, this is your cash value. This is how much you can take out in a loan.
By contract,
Done.
in the policy, by contract, we have first rights to those dollars.
Right. And so then, like, I take out a loan from my own whole life insurance policy to pay for a car, for example, right? So, and then rather than paying the interest on the car to the bank, I'm paying it to my own life insurance company that I have a ownership stake in, and paying back my own policy. And you can, because the interest rates are really low, part of this infinite banking system is then saying, well, rather than paying the low, 5%, it's probably not, I like my loans, I don't think are 5% interest. I think they're like way lower than that. But instead of paying like 5% back interest to my life insurance policy, I'm going to pay 5% to the life insurance company, and then I'm going to pay myself an additional 5% into a savings account somewhere, right? And so this is where you start getting the benefits of a private banking system, correct?
Well, yeah, and one thing that I didn't mention when we were talking about interest on a policy loan earlier is, even though the interest company is charging, quote, 5%, your cash value is also growing and compounding uninterrupted at the same time. So when I'm saying you're taking out a 5% loan, you run the numbers, it's not even close to that. And the whole idea with infinite banking and being able to leverage those dollars is to get on the positive side of interest, where you're compounding at a faster rate than you're paying in any interest that would go to the insurance company. So, that's important to understand, is just because there's a cost to capital doesn't mean that I'm still not creating value in my life somewhere.
Okay. So hopefully now, if you're listening to this, you're kind of understanding the basic mechanism: building up cash value, taking out loans against it, paying the loans back with interest, and accumulating the interest that you'd otherwise be losing to a bank. Now, it gets a little bit more complicated because, for example, I started 10 years ago almost with a $250 a month policy. You probably have a number of policies. How does it work once you start getting like multiple insurance policies into the system?
Well, it's a system of policies. That's really what it boils down to, because the policies don't communicate with each other or anything like that, or work together in any way. So depending on when you add on additional policies, I would say the simplest way to keep track of your system is on a spreadsheet. Just have it all line by line out there so that you can track everything. Nelson Nash, at one time in his life, he owned 49 different policies. And when we went to the think tank, which is sort of the national convention for infinite banking coaches, last year, was it last year? Yeah, last year in February. we got to see an example of the spreadsheet that Nelson used to use to keep up with all of his policies. And so as you start developing this system, you need some way to track it. And a spreadsheet, I would say, is probably the easiest way to track it all.
Okay. And this is the sort of the service that you provide as what do you call it? Infinite banking consultant, or how do you frame your services?
Well, I mean, yeah, we're infinite banking coaches. We're also licensed agents.
Coaches.
So we teach the concept. If someone sees the value in everything that we've taught them and shown them, then we'll come alongside them as their agents as well as their coaches and get them set up. But yeah, we're ongoing support, we're an ongoing resource for any of our clients that we work with. We don't charge by the hour or anything like that. So once somebody goes into our system, becomes one of our clients, then they have access to us.
You mentioned R. Nelson Nash a few times. I kind of want to talk a little bit about him because I think that this is how, hopefully this will spark an interest in people and they'll want to go learn more, and then they'll come to you. And when they're ready to really get like hands-on kind of coaching in this, they'll come to you. But the place to start is R. Nelson Nash. Who is R. Nelson Nash? How did he discover this concept? What's the name of his book? These are the questions.
Yeah, so Nelson Nash was actually trained as a forester early on in his career. And so he, forestry is one of those fields of study that if you're not a long-term thinker, you're not going to make it. Trees take a little bit of time to develop and grow and all that stuff. So he was trained in forestry. He was a long-term thinker just by his profession alone. But what he discovered in the 80s was interest rates had gone absolutely nuts. Prime rates just went through the roof. And he was also into real estate. He was doing some real estate investing and things like that. And he was staring down the barrel of about $500,000 loan that he had out on some property, and interest rates had just gone up to 20-something%. And so he found himself in a situation where he did not have the money to pay the interest on these things. It was going to probably bankrupt him. Now, he had, at a very early age, in his teenage years, Nelson had started putting money into whole life insurance policies because up until the stock market got really, really sexy in like the 60s and 70s, people had a decent amount of their portfolio allocated to whole life insurance because in terms of just safety and liquidity, it was whole life insurance and savings accounts. That's where people put money. And so he had put a lot of money into these policies over the years, but he never thought about using them in that way. So he said his story was, in the early morning hours on his knees, he found himself praying and asking the Lord just for guidance, just for an idea of, how to get out of the situation. And so he said it felt like God hit me upside the head with a 2x4 and said, look, you got these whole life insurance policies. You have access to money at a much lower interest rate than what the going rate is right now. So he was able to start leveraging the cash value in the policies that he had created for himself and actually get out of this nightmare of a situation that he was in. And it was through his experience of leveraging those policies that he saw something that other people didn't see, is that the mechanism, the function, so to speak, that he was experiencing and the way he was using his policies was much the same way that he would go get money from the bank. Only he was in control of the terms, where he wasn't having to deal with a traditional bank. And then that's where he figured out that, wow, there's something here that other people haven't seen yet.
Yeah. It's so fascinating to me every time I kind of reconsider this, that it's not more popular. And I think it just comes down to that it requires like real discipline and, I mean, frankly, kind of a sophisticated mindset to, I mean, you have to understand banking and interest and then have the discipline to force this upon yourself. And if you do, then it works 10 out of 10 times. Um, you mentioned that he was on his knees praying. I know that you're a Christian. I believe you're a pastor. Is that right?
Yes. Yeah.
Can you talk a little bit of, go ahead.
Oh, I'm
Sorry.
sorry. Yeah, I have a background in youth and music ministry, and then also some years in being a pastor as well.
Okay. How does your, because this is one of the things that when I was like 17 or 18, it really drew me to life insurance was sort of, I mean, the history. Life insurance was invented by a reverend in like the 1700s for his parishioners. I'm curious, like, how has your faith interacted with your line of work? And I mean, why is this a great business to be in as someone who's a Christian who's like devoted their life to Christ and to living a moral life according to Christian precepts? Can you talk a little bit about the relationship there?
Sure. One thing I'll say is, if I was a traditional financial advisor, I couldn't be that and also be in ministry, because one of the things that gives me a lot of peace about what I get to do is I know that if somebody listens to me, they're going to have success with the outcome.
Yeah.
So that really helps a lot. Now, as far as um, how my faith is aligned with my business, one of the things that I saw very early on is that my business was an extension of ministry. Um,
Yeah.
you think about one of the biggest causes of divorce in America is money issues in some way. I mean,
Yeah.
in the grand scheme of things, it's communication, but money is often a branch of that communication issue. And so what we find often is we can help actually bring couples together and get them aligned with their future. Dave Ramsey says that there's a spender and a saver in every relationship. And for the most part,
Hmm.
that's true. And one of the cool things about infinite banking is you can basically satisfy the spender and the saver simultaneously in the relationship, because you're still utilizing your capital, but at the same time, it's still sitting there, it's still growing for the future. So it gives couples something to be really excited about, that they can work together on their goals and their future and everything like that. But so much of Jesus's ministry was solving a physical need that someone had, and it opened them
Right.
up to the spiritual needs that they had. And
Right.
man, I've been able to share my faith with a lot of people, because when you have good information and you're helping someone with a physical need that they have, they're much willing to listen to everything else you got to say too.
Right. Right. Yeah. No, that's absolutely right. I mean, you see it when he fed the 5,000. I mean, he preaches and then he feeds them, and it's just, it is the sort of pattern of ministry in his, in the Lord's ministry. Uh, I love it. I love it. When I first discovered the other thing that's happening, I think with whole life insurance is that there's sort of this alignment of incentives between you, the company that is your insurance company, between your family. Like it just aligns everyone's incentives to look toward, hey, how can we sort of get each other's backs and also establish a strong financial foundation in the process without no one's getting anything over on anyone else in the equation. And so it's just a beautiful thing to behold. I'm a big fan of life insurance. I think it's super underrated. I want to give you the final word. Any plugs or asks for the audience, anything that we didn't cover or get to mention, the floor is yours.
So when we first started our business, we would meet with people one on one individually for an
Mhm.
hour, hour and a half on our own dime. We would just do that. We would educate, we would teach. What we found very early on is that there were very few people that were actually taking action from this incredible information that we gave.
Mhm.
So we actually started charging for our time in a sense.
Mhm.
So we created a course where you can actually learn all the ins and outs of infinite banking. Now it's there's kind of three parts to the course. The first part is There's some videos that we created that give you kind of a high level concept of infinite banking, everything like that. Then also we ship out Becoming Your Own Banker, the book that Nelson Nash wrote about infinite banking. We ship that out all over the country. So you go through our course, you go through our process, you get the videos, you get the book, and then you also get access to us one-on-one, where we actually start working with you through phone calls and video calls, all those things, to develop that custom strategy for you, to show you what infinite banking actually looks like in your life. Because infinite banking is a cool idea, but it's very theoretical until you see how it actually applies to you personally. And then it starts to take shape and make a lot more sense. So if someone sees the value in that, then we will move on to implementation and getting them set up and getting started. So there's a few different ways that you can contact us, reach out to us to kind of get started. One is through my Twitter account. It's my personal Twitter account. I named my Twitter Chronicles of Nate because when I started Twitter, I kind of saw it as a journey. My Twitter handle is Chronicles Nate without the of, because Twitter took that out. I didn't realize that at the time. So Chronicles of Nate is how you can find me on Twitter. You can also find us on our joint Instagram page, which is ULC Money. Unlimited Life Concepts is our company, ULC for short. So ULC Money on Instagram. And we've got some videos and other content that we put out there. And then there's also links in our bios where you can get to our course page and all that stuff.
Awesome. Nate Dean, that's it for this episode of the Justice Eapen Show. Thanks again to our guest, Nate Dean from Unlimited Life Concepts. And once again, I'm Justice Eapen. Don't forget to like and subscribe here on YouTube. Hit that bell for notifications. You can also find me on Instagram and Twitter and Facebook at Justice Eapen. So add me on all of those and join us again next week for more from the Justice Eapen Show. Nate, thank you so much for coming on, man.
Thank you for having me. I appreciate it, brother.